Okay, hi everyone. So thanks very much for coming to this seminar, which is presenting the emerging findings we have from the DIGITAX program, the first component of research. I'm gonna begin by giving an overview of the DIGITAX program itself and the context of what it is that we're researching. Then I'm gonna hand over to Awa, who will talk about the headline findings that we've got, and then I'll come back and talk about the emerging lessons, so the policy relevant recommendations from this work. Okay, so first of all, to give you an overview of the DIGITAX program. So the DIGITAX is a program of the ICTD, the International Centre for Tax and Development. We're a centre based here at IDS that has been going for over 10 years now, and that researches tax policy and administration questions in lower income countries, primarily in Africa. DIGITAX has been running for more than 3 years now. It's a program funded by the Bill and Melinda Gates Foundation, and it has two main components. So one component looks at the taxation of digital financial services. And by that, we primarily, but not exclusively, mean mobile money, which you may know has really transformed economic life in many African countries over the last decade. And the second component looks at the use of digital technology for tax administration. And that's not what we're going to talk about today. Hopefully, there'll be a subsequent seminar here at IDS to talk about that. So the DIGITAX program in total comprises around 30 research projects. Some of those are external projects, which we put out a call for proposals. External authors come to us with a proposal they want to do, and we fund it. And some of them are internal, led by the DIGITAX team. I'll show you them. There's quite a lot of people. And so I'm kind of a relatively late arrival. And so although I'm giving this presentation, I'm largely talking about other people's excellent research, not my own. And just to point out, these are the countries in which DIGITAX component 1 has its research. So you'll see we have a focus in a few countries. We're not covering the whole continent, but we do have a breadth across, for example, Francophone and Anglophone Africa, and between East, a bit of Southern and West Africa. So over the last 10 years, more and more countries in Africa have started to adopt taxes on mobile money services. You can imagine that you get this growing new financial industry, which is becoming more and more used, both for peer-to-peer transactions and also for market transactions. And government thinks, here's something I can tax. On top of that, you have growing fiscal pressures on governments. One of our main case studies is Ghana, for example, which is experiencing significant fiscal pressure right now and defaulted on its debts. And they think, right, we have to look everywhere we can to find additional bits of tax revenue. And the mobile money sector looks like one that would be a great thing to go to and to put a tax on. And so that's what we've seen spreading. You can see here in yellow all the countries that have adopted mobile money taxes over the last decade. The most recent was Zambia. It just came into force this last month, January. It's at a relatively low rate compared to some of the other countries, but it shows that the research we're doing is going to be relevant in the future as more and more countries consider this policy option. There's no standard approach to taxing mobile money. So some other forms of taxes that we commonly study, so personal income taxes, value-added taxes, and so on, there's a fairly standard approach that countries follow. There are options within that, there are choices within that, but broadly speaking, it looks roughly the same across most countries. Mobile money taxes is not like that. They're a new thing, they're growing organically, and they've been done very differently by different governments. So that gives us, on the one hand, a great chance to learn about what has worked well and what's worked less well, but it also makes it harder to draw general lessons because we're not comparing the same thing when we look at different countries. So a few ways in which they can vary. First is, what do you put the tax on? So you can tax fees, you can tax the fees that mobile money providers charge. So that's typically a percentage of the amount that's transacted. Or you can tax the transaction values themselves, or you can tax the turnover, the revenue generated by the company at the level of the company itself. And we find examples of all three of those, sometimes more than one of those, existing in the same country. I'll show you in a minute a table that breaks that down. Second way they can vary is the base that we tax. So there's roughly 4 different types of transactions that you could tax. You could tax deposits, when people take cash or money from a bank account and put it into their mobile money wallet. You can tax payments, so merchant payments, when somebody is transacting in a marketplace and they purchase something using mobile money. You can tax transfers between users. So for example, a migrant worker sends money back to their family in the village, and you can tax that transaction. And you can tax withdrawals, when people take money from their mobile money wallet out as cash. All those are points that you can tax. And again, the taxes vary in different countries as to which of those types of transaction they're levied on. And finally, another axis that's interesting to consider is how taxes on digital financial services compared to transactions on ordinary financial services. So for example, how does the tax on a transfer between mobile money users compare to the tax on a transfer between bank account users? And those are the kind of questions that we can ask and that we can compare. The other thing to say about mobile money taxes is that partly because of the fiscal pressures that many countries are experiencing on the African continent at the moment, they're often been introduced outside the normal budget process in a way that has circumvented some of the standard approaches to policy formulation, to modeling of the impacts, and to democratic scrutiny of the taxes. And so that's often meant that what we've got is kind of a rushed introduction of a tax. Then there's been a popular backlash, and that backlash has led to the tax changing. So part of what we're studying here is a moving target, because in many of the countries we look at, the tax looks different from year to year as government adjusts in response to the industry response and the public response and the political response. So to give you a couple of examples of that, Ghana, and Awa will be talking a lot about Ghana later on. It's a country where we've done a lot of research. They introduced a mobile money tax during the period that this program's been running. So we've been able to study it right from start to where we are now. They first announced it at a rate of 1.75% on transaction values. So not on the fees, but on the whole transaction. And then by the time they actually introduced that as legislation, they had reduced it down to 1.5% because of criticism that the rate was too high. But then after the tax came into force, there were protests. There was a lot of anger around it's called the e-levy in Ghana. And as a result, the tax rate was revised down again to 1%, and a minimum daily threshold was introduced. So in Ghana, you pay tax if you transact more than 100 cedi a day. That's introduced afterwards. So the governments have been doing course correction in Ghana in response to the reception to the tax they've experienced. Ghana is one of the many countries that has elections this year, and it's likely that the e-levy is going to be a major political aspect of that, and the government is aware of that when they're thinking about the design of it. Uganda is another example. So Uganda actually has one of the most long-standing taxes on mobile money, which is an excise duty on fees. So just on the fee, not on the transaction value. That's been around since 2013, and it didn't seem to generate much controversy when it was introduced. Then in 2018, the president decreed that he wanted to see a tax on transaction values. And so again, very quickly, a new tax was introduced, and it was a 1% tax on all types of transactions. So on deposits into accounts, on payments made by mobile money, on transfers between mobile money accounts, and on withdrawals. So you can imagine that tax rate of 1% for the kind of use people might make, it may cumulatively become 2, 3, 4% as it cascades through the system. There was a huge backlash to that. Again, you see a protest here about that. And already by November, within a few months, the government had backtracked. So now it's tax levied at 0.5%, and it's levied only on withdrawals of money from the system. That's an interesting situation because the mobile money providers are actually fairly happy with that, because it incentivizes people to keep their money in mobile money rather than withdrawing it as cash. But it's probably not how you'd have designed it if you started from the beginning. So that gives an illustration of the kind of ways in which mobile money taxes have been introduced and how they've been politicized in countries that we've studied. So this table just gives you an idea of the different design features. This is just to illustrate the extent to which we're comparing different things here. And there is maybe, like, you can see kind of a model that certain Francophone countries have adopted of taxing turnover. That's in red in this table. You can see several countries have that. Then in the Anglophone world, it's more likely to be taxes on values and taxes on transfer fees. Our study has focused in the program largely on these 4 countries. And so that's the research that we're going to be largely drawing from when we talk today. Ghana, Kenya, Tanzania, and Uganda. And you can see that they have taxes on values, some of them, and on fees, some of them, and they're levied in different ways. They have different characteristics. Okay, I'm going to pass to Awa now, who's going to talk about the headline findings from the research we've done. Are these taxes online? Or do you have to share and payment? Maybe I can pass that to you, Awa.
What?
The question is, are taxes levied automatically, or do you have to declare at the end of the year to pay them?
Okay. So I can give the example of Ghana to answer your question. So in Ghana, there is a common platform where mobile money providers will declare the total transactions that have been done during the month. And then the government would collect the tax based on those declared transactions from the mobile money operators. Then it can be different in other countries, but I specifically know the Ghana case. Okay, so now I will present key findings from our research. So we've used many types of data to estimate the impact of DFS taxation in African countries. For example, in Ghana, we've done surveys with 1,500 households and individuals using or not using mobile money to see how they perceive those taxes and how they use mobile money, but also information on what they do, their demographics and economic situation. We've also did in-depth interviews with main stakeholders, namely mobile money operators, mobile money agents, civil society organizations, to see how they reacted to the tax and what they think about it. And we've also done focus group discussions with different groups to see how they can also perceive the tax. So our findings can be summarized in these 3 main points. The first one is about tax revenue. In Ghana, for example, we see that tax revenue collected from the e-levy are far below expectations, so projections that the government did before applying the tax. The second point is about impact. We see that impacts are real, but we find them mostly in the short term, because in the long or medium term, there is a recovery of the trend of mobile money usage. So when we talk to mobile money providers, we see that the tax impacted the supply side with a decrease in their turnover right after the application of those taxes. We also find some regressivity where more vulnerable household or individuals are more impacted by the tax. And finally, we see that knowledge and perceptions matter to explain impact. And that's basically what I will present today. So I will start with tax revenue. In Ghana, the contributory capacity of the e-levy has been widely overestimated. So during the first month of application, as I will show later, so during the first month, the government only had 10% of revenue expectations, and this can be explained by 3 main points. First of all, wrong estimations, because the data that has been used to estimate revenue projection has been collected during the COVID-19 pandemic, where people needed more mobile money because of restrictions. Second point, it can also be explained by the fact that there is some inefficiency in the implementation process, because in that common platform that I was talking about, sometimes not all transactions are reported by mobile money operators, which can also decrease the tax base. And finally, people can change their behavior to protest against the e-levy, which can also decrease the tax base. So on this graph, we present the difference between revenue projections from the government and actual tax revenue collected from the e-levy in Ghana. And as you can see, during the first month of application, the government only had 10% of projections. So in January 2023, the government had to revise projections in order to be closer to the real contributory capacity of the e-levy, which shows that maybe the e-levy is providing much less than what the government was expecting. So with data from revenue authorities in Ghana and Uganda, we can give some interesting insight on how much those DFS taxes are providing in terms of tax revenue. So in Ghana, the e-levy is providing more or less 4% of domestic indirect tax revenue and 1.1% of total tax revenue. And in Uganda, the combination of a tax on fees and values is providing 6% of indirect tax revenue and 1.3% of total tax revenue. So this can seem little, when 1% of tax revenue can seem very little compared to other taxes like VAT, but it's not that negligible, because in Ghana, for example, the e-levy is providing more than the excise duty applied on alcohol or tobacco, and the e-levy is just applied on one service, which is a mobile money transfer. So these taxes can also bring important tax revenue in a very challenging fiscal situation where countries also need a tax revenue to deal with a bad economic situation. So now there is an arbitrage to do between tax revenue collection objective and also the protection of financial inclusion for, let's say, vulnerable strata, because the main argument against DFS taxes is the fact that they could hurt financial inclusion for some vulnerable people in African countries, because mobile money is a very important tool to increase financial inclusion. And that's why we are very interested in impact. So what we see is that in the short term, there is an immediate drop in mobile money usage after the application of mobile money taxes. And we can say that based on data from Uganda, Tanzania, and Ghana. But in the long term or medium term, we see a recovery. For example, in Kenya, Uganda and Ghana, we don't see any significant impact of those taxes in the long term, meaning that people go back to their initial level of using mobile money after that immediate drop. And in Kenya, using national level data, we don't see any significant effect of the tax applied on fees since 2013. But when we use micro level data, we see very interesting difference that I will mention later. So here we illustrate transaction values as share of GDP in Uganda, and we cover the period before and after the first introduction and revision of the tax on DFS. So when the tax has been applied on transaction fees in 2013, we don't see any significant change in the trend. But in 2018, when a tax has been applied on transaction values, we can see an immediate drop in transaction values as share of GDP, but then we also see a recovery in the medium term, as we've just said. So the same trend is observed in Ghana here, where for sending and receiving, there is an immediate drop after the application of the tax in May 2022, but then it's the same. We also see a recovery in the medium long term. And an exception is Kenya, because when the tax on fees has been applied in 2013 and revised in 2018, we don't see any significant change with aggregated data. Well, this can also be explained by the fact that the Kenya case is a little bit different because it's a tax on transaction fees, which is different from transaction values or operator turnover. So that difference can also be explained by the design of those DFS taxes. So on this slide, we present some insight that we collected from the supply side, namely mobile money operators and mobile money agents. So in Ghana, the first thing that mobile money operators reported is the lack of consultancy during the policymaking process. So they argue that maybe if they have been consulted, the tax revenue, the policy making of the tax would be better, maybe because they know better the market and they could provide interesting data and insight to the state to do a better or more accurate estimation of the tax revenue that they can collect from the e-levy. And second, they also reported a negative impact of the e-levy on their activity, which is that short-term drop. And even though we see a recovery in mobile money usage, they also say that there is a permanent reduction in absolute amount that won't be recovered. What is also interesting is that mobile money operators feel that the e-levy did not have the impact of a normal price change because people not only reacted to the e-levy, but also the bad fiscal situation with a high inflation rate, but also other taxes that the government applied just before the e-levy. And what is also interesting is that mobile money agents, which are between operators and consumers, also suffered from the e-levy and applied some non-regulatory coping strategy to deal with the tax. In Cameroon, the same trend is observed with a negative effect on agent profitability and sustainability, but also after the Cameroon tax on mobile money, researchers also saw that agents were more likely to apply non-regulatory fees. And the last point about impact is some regressivity that we remark on the tax applied on DFS. In Ghana, we've done a study on merchants. And as maybe Martin said, there is an exemption for transaction made to registered businesses, meaning that if a business is registered with a GRA for VAT or income tax, then that business can receive transactions that won't be charged, the e-levy. And what we see is that smaller and less sophisticated merchants, they do not benefit from the e-levy exemption. In Cameroon, the study saw that smaller and more vulnerable agents, they incurred a bigger decline in their profitability and revenue sustainability. And in Kenya, when we use survey data, so micro-level data, we see that individual and household that are poorer and larger household, they suffered more from the tax compared to other households. So there is some regressivity of DFS taxes in some contexts. So the last point of our research is about the link between knowledge, agreement, and behavioral change. And this is mainly our theoretical framework. So we assume that political affiliation, demographics, and specified merchant status, but also knowledge, can shape how people perceive those taxes and their level of agreement or disagreement with those taxes. And we also assume that the level of knowledge, but also agreement, can also explain how people react to those DFS taxes. And we use the Ghana case and the survey that we did to test this theoretical framework. So first of all, what do Ghanaians know about the e-levy? So we've asked to our respondent if they know different designs of the e-levy, and we saw that they, for example, know that the e-levy applies to transfers. So 93% know that the e-levy applies to transfers, and that the e-levy doesn't apply to deposit. But when we're interested in the tax rate or the daily threshold, we see that the level of knowledge is much lower. For example, only 90% of people know that the tax rate is currently 1%. And when we try to explain agreement, first of all, the level of agreement is very low. Almost 70% of people disagree or strongly disagree with the e-levy in Ghana. And when we try to explain it, we see that knowledge matters a lot. So not knowing the rate increases the level of disagreement. And when people know the threshold, they tend to disagree more with the e-levy. We also see that demographics matter because women tend to disagree more with the e-levy, and political affiliation is also very important because people who support the current government tend to agree more with the e-levy, which also explains why the political side is important to look at. And now we are interested in behavioral change. So it's important to see this because almost half of our sample reported to have changed their behavior after the e-levy has been applied. So people could use more cash to avoid paying the e-levy, or they can decide to transact below the threshold. So as Martin said, you can send up to 100 cedis per day without paying the e-levy. So I could just, if I have 200 to send, I can send 100 today and 100 tomorrow, and it would allow me not to be charged. So people can also send through an agent account. So this is not legal, but people can just make a deposit in the recipient account instead of doing a normal transfer to avoid paying the e-levy. So this is a question that we've asked during the survey. And when we try to see what explains behavioral change, we see that agreement is a very important determinant, with people who agree with the e-levy tending to, let's say, not changing their behavior, and people who disagree that tend to change their behavior to avoid paying the e-levy. So knowledge matters to explain agreement, and agreement matters to explain behavioral change. I think That's it for me. I will let Martin present policy recommendations.
Okay, so I've got 2 slides with some lessons that are emerging on them. I'm just wondering if I can remove this bar here. Can I hide that just so it doesn't, oh, there it's there, isn't it? Hide photo meeting. There we go. Yeah. So the first slide's on policy, politics, and processes, and the second one will be on tax design. So a few things that we think we've concluded that are important things to consider when thinking about how these taxes will play out in the real world. So the first thing is that the decision to adopt one of these taxes in most of the countries that have chosen to adopt them has been made because of fiscal pressures and political pressures, which means a lot of the time a discussion about whether or not the tax is a good idea, what will be the impact, how to do that trade-off, that arbitrage that Awa talked about between revenue raising and potential harmful impacts. That's a discussion about how to implement a tax in a way that raises the most revenue and mitigates those negative impacts. It's not a discussion about whether or not to do it in the first place, because generally the decision has already been taken at political level. So that's one of the first things to say. Second thing is that revenue collection performance does seem to be lower than has generally been projected. Now, that may be largely to do with the fact that adequate work to project in advance hasn't been done well, or it may be to do with the fact that maybe this isn't the most efficient tax to collect. I think more research is needed on that. I think Awa showed the figure that it's around 60%, still only around 60% in Ghana that we're seeing of transactions registered on the common platform compared to what you would, compared to the total amount that is there in the tax base. So there's still work to do to try and increase the efficiency of tax collection. So thirdly, the accelerated timelines that governments are using to introduce mobile money taxes, and this is not unique to mobile money taxes, it happens with other tax measures, but it's a particularity, it seems, of mobile money taxes, means that they are being introduced without adequate consultation with industry and other groups that are affected, without the adequate consultation, the design features sometimes miss important considerations. It means that projections may not be right, and ultimately the scrutiny that you'd want to have, partly to ensure the tax is designed well, but also partly to try and do the political work of preparing the groundwork to introduce a tax and building support for it, isn't there. And that's why sometimes you get these backlashes that we've seen in many times, in fact. And the problem we found, certainly in the in-depth work we've done in Ghana, is that those fumbled introductions, when a government introduces a tax and then has to backtrack, they have lasting impacts. So even if you dismantle the problematic aspects of your tax in a redesign, perceptions are still damaged. Not everybody understands that you've dismantled it. And even if they do, their sentiment towards the tax is affected. And as I was talked about, people's sentiment affects the way they behave in response to the tax. So getting it right when you first introduce it is a helpful way to ensure that the tax is then more sustainably introduced in a way that's going to have widespread acceptance. And finally, then for governments to be more transparent and organized and orderly in the way that they communicate about the tax, that's partly through the political process and partly once it's introduced, the communications they do, ensuring that people have the right knowledge about the way the tax is designed, both because that will help them to shape their to behave in a way that responds to the incentives government has created, and partly because their knowledge will shape their sentiment, and their sentiment shapes how they behave as well. And that will help to shape acceptance of the tax, but will also help to shape equity, because one of the implications of the story from Ghana is that although there's an exemption built into the tax designed to minimize its impact on the poorest, if people don't know about that exemption or understand how it works, they don't necessarily benefit from it as much as government wants. So getting the communication right is important, not just for acceptance and politics, but also for ensuring the tax works the way it's been designed to work. And the second set of lessons around tax design. Now, as I said, we're a little bit cautious about making recommendations that are very generalized about what a good mobile money tax looks like, because we have such different contexts in different countries, and we have such different, we don't have the kind of the strong comparative results that we could have if countries were introducing similar taxes. But we can say a few things, and we can raise a few questions. So the first is that the way in which mobile money taxes are mobile money is taxed compared to traditional financial services is different in different countries. Some countries it's taxed more heavily. Uganda would be an example. Some countries it's taxed more lightly, and historically Kenya would be an example of that. Now, if your government is very concerned about having a digital industrial strategy, about trying to shift the economy and prepare it for the digital era that we're entering in terms of trade and development, then you probably want to be incentivizing people to adopt digital financial services, which means taxing them more heavily might not make sense, except of course it depends on the market structure, because you may find that because it's become ubiquitous, the elasticity of the tax is quite low, and so you can actually tax it more than other services that are more have a greater elasticity. So I think aiming for neutrality might be the right goal, right way to frame a goal, but there are different impacts and different objectives there. Secondly, the choice of tax. One thing that we noticed is that it seems to us that excise taxes, that's taxes on fees, and taxes on the turnover of companies have seemed to generate less backlash than taxes on transaction values. So it would seem that a sustainable tax in terms of public opinion and political support is probably one which isn't levied on transaction values. Now, that's a very tentative thing to say, and there are exceptions. But there are kind of problems with this. So the problem with an excise duty is that it's a tax levied on the fees, and the fee structure itself is regressive. So if you tax the fees, maybe people won't notice so much, they won't object so much. But it does mean that if your objective is to be progressive in the way you introduce a tax, it won't necessarily achieve that. Taxes on turnover, we're still waiting to see whether or not in practice how exactly they are passed on to users, because while they're not levied at the level of a transaction, so in a way that a consumer will see, clearly they're likely to be passed on. Although we're interested in the fact that in Cote d'Ivoire there's a legislation that prevents it being passed on. Formally, at least, providers are prevented from passing it on to users. Whether that actually happens, we don't. Whether that works in practice is another question. Another thing is about choice of transaction type. So what we saw in Ghana and Uganda was that levying a tax on all 4 types of transaction made the tax unsustainable. And it seems like it was probably a design error rather than a conscious choice that didn't work out. But a tax only on withdrawals, it has some strange perverse effects, perhaps. So it's, as I said at the start, it's generally quite good for the industry because it means people leave their money in their mobile wallets. But sometimes withdrawing money as cash is something that people need to do. And if that's the point at which they pay tax, it can create a perverse incentive. So working out what's the right transaction to tax and ensuring you understand exactly how people use mobile money, what are their usual use cases, and how you can avoid too much multiple taxation in those use cases is a work that governments need to do in designing the tax. Fourth, exemptions and price controls can alleviate regressivity. So we saw that in our study from Ghana, that it's clear that the tax would be more regressive if it weren't for the exemptions and the price controls that had been built in. And finally, a final point, which chimes with a lot of work that we say across the ICTD. If taxing informal activity is a goal, and we can question whether that should be the right way of framing a goal, many people think mobile money taxes are a good way to do that because you can tax businesses which are making money in the informal sector, which otherwise you wouldn't be able to reach with your direct taxes. But they're a regressive way to do that. And so it comes down to the choice governments are making here. This is a way to raise revenue, maybe raise revenue from different parts of the economy than it could otherwise reach, but there are costs, and that's the trade-off governments need to evaluate. So that's what we had to say, and thanks for your attention. I hope we'll have some great questions.
Thank you.
All right, thank you very much, Martin. And I think this is a very insightful presentation on your findings. And I'm just going to now open up to the floor if there's anyone online that will have any questions. So we have Shandana.
Thank you, Martin, and this is great. I really enjoyed that, and also you already answered a lot of my so what questions. So the last 2 slides had a lot of what do we want to do with it. It was really just the last few points that I wanted to help build with, sort of build up with you a little bit more. Is what does progressivity look like in this? So that's a struggle across so many kinds of taxes. And so within something like this, what is progressivity? You suggested a few of them, but also is it increasing the tax based on the amount of the transaction or the sorts of goods? But how possible is it to build in progressivity into these kinds of things that the governments will try?
Okay, thank you, Shandana. I think maybe we should take a couple of questions and then give you guys the opportunity.
Take that.
Thanks very much. I really enjoyed that and learned a lot. One comment and a question. The comment was, you mentioned that the tax amount is very small as a proportion of total tax revenue at the moment, around 1%, 1.3%, I think, in many countries. Obviously, though, this is going to grow, right? Because we're seeing, and you can see from your own graphs, how the number and value of transactions digitally is increasing, and that's going to continue. So presumably that's going to rise to quite a significant percentage in a few years' time. My question is, looking at that graph where Ghana overestimated the revenue that they expected to collect, and it led me to think about whether that's because they overestimated the value of transactions that are done digitally, or because there was non-compliance and tax evasion. And that comes to the question of how the money is collected that I raised earlier. If you put the levy directly onto the transactions, electronically deducted automatically, then of course there's 100% compliance unless you evade that by doing other types of transfers. But if people have to declare and pay to the Revenue Collection Authority, what's to force them to do that? Are these financial transactions open to the government, to the financial service providers, MOs, and all that have to provide that information to government auditors? Or is there some privacy and confidentiality around financial transactions that means they can't access that? In which case, why should people declare and pay?
Okay, thank you. So I'll take one more question before I give you a chance to respond.
Among the things you discussed there on the impact of the taxes, you said that there is huge impact on, you discovered impact for Tanzania, but I didn't get the discussion well. So if you could clarify that more, what sort of impact from what I know, they abolished that tax. Thank you.
Thank you.
I think, luckily for me, these are almost all questions that I'm going to pass to we can talk about Tanzania, can't we? Because we don't use it because we haven't published yet, but we can talk here about the findings.
Yeah,
Yeah,
okay.
yeah. So I'm going to leave it to you and then.
Yeah, right. Okay. Thanks very much for your questions. So I will start with Shandana's question on progressivity. I think what progressivity would want here is that those DFS taxes would not hurt financial inclusion for more vulnerable strata. So in some countries, like Nigeria, Ghana, there is a tax exemption for little amount transactions where, so when we assume that poor people do those little transactions, if we exempt that, maybe they wouldn't be that hurt by those DFS taxes. But when we look at our survey data, we see that sometimes it's rich people who actually use more mobile money, and so maybe those taxes could not be that regressive if it's rich people using mobile money. But it's a question that deserves more research, because we have to find out who is using mobile money, who is using affected transactions before knowing how regressive or progressive those taxes could be. But in the way of designing those taxes, we can also say that maybe exempting little transaction amount could also be an interesting thing to do to avoid some regressivity. I don't know if it answers your question.
Part of it, you had exemptions, but I was just wondering, as you go up, can you make it progressive in design? So I realize the impact, you can't get it.
Okay.
In design, get it, keep getting more progressive beyond the exemptions, which is the obvious one. And then beyond that, but it's fine. We can.
I think governments are trying to do an arbitrage between simplicity and progressivity, because if the tax rate would increase with transaction amount, then maybe it would be more complicated for them to implement the tax. But in some countries, like in Ghana, there is a cap for transaction fees, which can also be applied with the e-levy. Like from a certain amount, the tax would be more important. But when it attained a certain, like a bigger amount, then the tax would not increase. So this is applied for fees, but I don't see a country where it's the DFS tax includes that kind of reform. Okay, so for the second question on why and how the contributory capacity of the tax has been overestimated in Ghana. So during our interviews with stakeholders, we, as I said, we remarked three things. And the first one is about the data that the government used. So I think that estimations has not been accurate because those estimations have been based on data collected during the COVID-19 pandemic, where people use mobile money a lot, and it might not be accurate or reflect the real level of mobile money usage. So people could just go back using cash after the e-levy. But also, as you say, the way in which they are implementing the e-levy can also have some inefficiency, because mobile money operators have to declare all transactions on the common platform, and the e-levy is applied based on that reported transaction value. And then what the GRA is currently doing is to compare transactions declared by the Bank of Ghana to transactions declared on the common platform. And as I showed, there is some difference. And currently they are collecting 60%, which is better than the 20% that they were collecting at the very beginning. But there are still some issues that they are trying to deal with. And the last question is about impact in Tanzania. So in Tanzania, we've analyzed operator data with data before and after the application of and revisions of the tax. And what we found is that people reacted very much to the tax at the very beginning when the tax has been applied. But then when the government decided to decrease the tax rate, then people went back to their way of doing of using mobile money. So we've not published the study yet, but I think that there were some kind of impact, but then people adjusted their way of using mobile money after the revisions of the tax.
And just to add one thing in response to Shandana's question, although she's gone now, is that, which is, I guess, not every tax that you introduce is a tax that you can make as progressive as another tax. I think this is always going to be a tax which is not amongst the most progressive that governments can introduce. And the question is, what else are governments doing to tax people at the top end of the income spectrum, maybe?
Thank you. Are there any other questions?
Yes, a question from our online audience. This is from Mapikiso. How do you design or use DFS tax to target specific taxpayers, SEEMs, whose route revenue through mobile money?
I don't get the question.
SEMs, does he mean SMEs?
MMEs.
Oh, small, micro, medium. Yeah. So how can you design a mobile money tax if you want to target, for example, small and micro enterprises, particularly?
Oh, okay. Well,
I mean, to some extent, what they've done in Ghana
with
is
Ghana, yeah, it's more or less the same thing. So in Ghana, one objective of the e-levy is to target the informal sector. So if you can compare the informal sector to those micro enterprises, maybe it can be useful. But then what we found during our in-depth interviews with the informal sector is that it's not very, I don't know, efficient to make them register with the GRA, because they could just go back to use cash. Mobile money is not that important in their activity, so they can just go back to cash. But if the government wants to make them register or pay their taxes, they would have to use other incentives like social protection measures or sanitation services. So maybe using mobile money taxes to target those little enterprises won't be that efficient, because they could just go back to cash, I think.
Yeah, I think it's a really good example of the tension governments are facing, right? Because on the one hand, they want, for various policy reasons, to see those smaller micro enterprises. I'm looking at you, but it's not your question. The smaller micro enterprises formalize and use and move into, for example, using digital financial services. So I guess it's not necessary. It could work against their interests to tax them too heavily if what they want to do is incentivize them to start using these financial services. And I guess that's the tightrope that they're walking a bit.
Right.
Thank you so much for the presentation. I'm curious to know if there is any relation between VSLAs and, for example, Tanzania to this platform. VSLA is the Village Saving and Loans Associations, where a group of people come together, save and lend.
You know what I think about that? Well, yeah, no, we don't know, but it's an interesting question. Maybe we'll talk about it afterwards. Or maybe one of our colleagues at the back there knows.
So I was just thinking in relation to what you last said about that tightrope that they're walking, that in many countries, you see fiscal incentives to adopt cashless payments as a kind of tool for tax compliance, right? The logic being, if we get people out of using cash and into using digital payment mechanisms, then we can trace and more of their transactions will be more visible to the tax authorities. I mean, lots of assumptions baked in there about those transactions actually being visible to the tax authority, but leave that aside. And now in these African countries which are taxing mobile money transactions, it's sort of like the opposite idea on what to incentivize. And I wondered whether you think we could do any work in the future about VAT compliance and the relationship between these mobile money taxes and VAT compliance, and whether there's some sort of link between those two things.
Yeah. Sure. Yeah, I mean, I guess also as we see, the boundaries between different bits of the, like as we see the VAT systems adapting to digitalization, both in terms of the economic substance that they're taxing and in terms of the way they're being administered, it makes a lot of sense to look at the interface between these two.
I was just going to comment on your question. Not that we've done any studies on it, but just based off of what those groups would be doing, it's all about saving. So the saving element wouldn't be impacted because it's all about transfers and transactions. But what would be impacted is remittances. So if they're receiving remittances from family abroad and that is their saving mechanism, then that would reduce. I do think Tanzania, if I remember correctly, they had a ladder system in terms of their tax. So between different amounts, they would tax differently. So I wonder, if maybe the flow of income would be less so that they would get taxed less or at a certain amount. But like savings wise, if it's just about a saving mechanism, then the tax shouldn't impact that element. Yeah.
Thank you.
Thanks. I'm really fascinated by the political costs of these programs. I mean, I could see why people might be very resentful of this. If you're working in town and sending money back to your poor relatives in the village, what right has the government to take some of that money away? So if there's a negative political perception to these taxes, is there a big political cost that governments are paying for it, or not really?
I mean, we think in general terms, yes. I mean, that's why you saw the rapid backtracking in Uganda, and that's why Ghana has redesigned as well. And it is very politicized in Ghana now. So it was likely to be two main parties contesting the election, one proposing to keep the e-levy, one proposing to scrap it. I think you see that in all kinds of countries, and you see it here in certain taxes where it's kind of widely accepted this tax is a very efficient thing to do, but it's politically costly to governments, and so it doesn't happen. So I think in some ways you can say that governments have been quite courageous so far when they've done it. I think the point is it's been more costly to them than it needed to be, because the way in which they've done it has not prepared the ground well enough and has needlessly included design elements which have had created more outrage than was necessary. So I'd say that's probably the best way of thinking about it.
Hey, any more questions? Anyone online? No one. Okay. Well, I have a question. Considering that a lot of governments are kind of looking towards digitalizing social protection, which involves mobile money transfers. I wonder if in any of your studies, there were considerations for exempting such transactions, because it would then lead to probably less money reaching the beneficiaries of social protection?
We haven't looked at that side, but I think it's a very interesting point. I saw some studies on how DFS taxes could also impact remittances that the government would send to people for social protection. And I think it's also an argument against those taxes because it would maybe increase the cost of doing social protection measures or decrease the amount that the household would receive. But I don't think that we've looked at it. But yeah, it's an interesting point.
I mean, I suppose it's part of this, right back to this tightrope the government's walking, because the argument is that the long-term objective would be that digital financial services are so ubiquitous that if the government wants to introduce a social protection scheme like that, or like an emergency scheme in response to a pandemic, for example, they can do that very easily because everybody is included in the financial system in that way. So then that fits with the argument that you should be very careful in the way you design your mobile money taxes so that you don't incentivize that. But that's largely framed in terms of the long-term objective. I would kind of assume that if government wants to ensure that it can get money to people without it being taxed, that government can ensure that it can design its tax system and its social protection system in a way to circumvent that to some extent. So I think I feel like it's more about the longer term, that longer term objective of getting everybody into the financial system, which is not without its issues to debate.
Yeah. Okay. All right. I think this comes to the end of the presentation. A nice closing to it. Design consultation, which obviously also has a lot to also look into in research around how that actually happens, how that actually unfolds, political economy around that. But I also want to thank you, Martin, and this has been a really interesting presentation, also for myself from the digital cluster, learning from your side of things. And I hope this kind of opens up collaborations in the future. Thank you everyone for coming today.
Oh, yes.